In this video, guys, we're going to look at the difference, or which is better, Forex or stocks. Some pros, some cons. Stay tuned. Hey guys, warm welcome to, so which is better, Forex or stocks? I'm going to put some pros and cons or some positives of both of those, and let's kind of see which suits you as a trader. Because many people default to one or the other, right? Generally speaking, this is the pathway. Someone who has been investing before, whether that's in UK stocks, US stocks, often starts to trade stocks. Those who have not been investing and come into the markets fresh often head to currencies and Forex because that's what is presented to them when you're searching for day trading, when you're searching for swing trading, when you're searching for financial markets. Generally, Forex is the ones that are hammering all the ads, hammering all the marketing, and so you naturally get drawn into that. For me, when I started trading, the first things I traded were UK stocks back in 2001, and I first started when somebody spoke to me about the stock market. Didn't know anything about it, and of course I got involved in it. I actually bought some stock. It magically went up over a kind of month period. I looked at it and thought, wow, that's amazing, and then that was it. I was committed and I was into more aggressive trading and more higher frequency trading on UK stocks. I'd never even heard of currencies at that point in time, so it tends to be how you get drawn into it. Once you're in it, now you're here, you're aware that there are commodities, there are stocks, there are Forex. Maybe a different one is more suited for you. So let's look at some of the pros of currencies. So less margin is generally the bigger one. Now that's not quite right at the moment with ESMA because they've changed the rules for the Europe a little bit. But generally speaking, like, you can handle a lot more money with Forex. You don't need as much money to get the same sort of exposure. Generally speaking, that's normally the case. They're very, very liquid. Now, does that really matter for most of us? It probably doesn't. And you've got to be a bit cautious when someone says, "Oh, I trade Forex because it's the most liquid thing ever." Listen, you and I with up to £1 million account can trade almost all the stocks we need to. So liquidity is not an issue when you're talking less than £1 million account. When you've got size like 100 million, then maybe some of the stocks start to drop off, right? You can't start to trade some of the thinner stocks, maybe at 1 million or so, but you get the point. You can still trade a massive universe of stocks. So yeah, the liquidity is handy to have, but a little bit cautious about that one. The other one is loads of data. What do I mean by that? So because so many people trade FX, there's loads of tools, there's loads of data. Look at this one as well, free charts. So if you really kind of want to get involved in trading and not spend much, then FX is perfect, right? There's a low barrier to entry. We put that in as well. There's probably the same type of thing. In other words, you can start with a few $100 or a few £100, and you get free data. You can get all the analysis you need. There's loads of information out there. You can get tons of tools for free, and you can just get going. Whereas stocks, commodities, there's a little bit higher barrier to entry. Costs a little bit more. You have to pay for specific stock data if you want the whole array of data. You have to pay for kind of level 2 data if you want to get that granular with it. You have to pay a bit more for research. Whereas, you know, there's so much stuff out there you can get started with FX. Now, I guess that could also be a bit of a con as well, because there's a lot of noise out there, as in pro and con, not as in con as in scam. There's a lot of noise out there, but you know, generally speaking, low barrier to entry and free charts is good for people who are kind of getting just casually into the business. The final thing is no day trading rules. Unlike stocks, where you've got patent day trading rules where you must have $25,000 or more if you're basically a day trader, none of that restrictions with FX. You can scalp, you can do whatever you want. The world's your oyster, if you like. Spreads also are pretty narrow as well, and costs to trade much lower than stocks, generally speaking. Although, you know, depending on what stock you're trading, but generally speaking, if you're trading, say, euro, US dollar, it's almost free to trade. What's the spread on that with your broker? Hardly anything, right? 0.4, 0.6, if that. And if you're trading via some sort of interbank market, the commissions are really, really small as well. So it's cheap to trade. It's a cheap way of getting involved in trading somehow, which is why a lot of people kind of find that path and then stick with it. Right, let's look at the pros of stocks. So I've put more extreme swings here, and I'm going to stand by that, guys. I believe that stocks generally have more extreme swings. Perhaps if you average it all out, not, but I think on certain stocks, you know, you can see massive swings. Now, that's just not to say that Forex doesn't get swinging when it does. You know, if you trade it for a while, you'll know that we see serious moves often in currency pairs, but they can go years without doing anything, and actually a lot of them can be stagnant all at once. Whereas stocks, you're always going to get something that's swinging, and even some of the big kind of Facebooks and Amazons and the big kind of market caps have big extreme swings as well, and that's not even considering some of the smaller ones like your biotechs, some of your lower tier ones that are just really swing on you. So more extreme swings can be a pro, and I think it's a pro for day traders and swing traders. Another one is a larger universe to trade. So yes, there are a lot of currency pairs. There's your minors, there's your exotics, your majors, etc. But there's way more stocks. So if you're set up specific, i.e. you're looking to trade trends, then you're more likely to find what you need in a chart in the stock universe than you are in the currency universe. Another one which is a good one for me, which I like, is gaps. I like trading gaps. I like the distinct fact of a gap. Obviously with currencies being 24/5, you only get that Sunday evening gap, or you might get a gap for some sort of really extreme news, but it's super rare. That gaps, though, however, you've got an opening and a closing on stocks, and so that can generate opportunities in itself. Then you've got earnings. So earnings, okay, I guess you could probably say we've got economic data with Forex, but generally economic data doesn't really hit the market that hard unless it's well out of swing one way or the other. Earnings, however, only slightly sometimes out one way or the other, or even if they're kind of expected, but people don't know what's going to come out, then a slight move either way with the earnings can cause it to you get some really distinct movements. So that's quite handy as well. And also if you're trading options based on stocks, the earnings offer some good opportunities there. So more opportunity in general. So really large universe to trade. But generally speaking, like if you think about the amount of stocks that are out there and the amount of things there are there, means that one of the big kind of psychological things that I find with FX versus stocks is a lot of people kind of trade maybe 5 or 6 FX pairs, or maybe 2 or 3 FX pairs. One they just can't seem to get a handle on. It gets frustrating. They have to revisit it. Whereas stocks, if you find that Apple just can't get hold of Apple, you just don't trade Apple. There's thousands of others that you can trade. So the opportunities are very plentiful on that. Long versus short. This is more of a distinct kind of trade idea, right? If you think that a stock is long, you're just bullish on the stock. You think that company is going to increase in value. If you're short on the stock, you're just bearish. You think it's going to decrease in value. It's a very simple kind of trade. Whereas slight bit of complexity when you're trading in a currency pair, because they're paired against another, you're going long. You're not necessarily going long one. You're basically saying that it's going to outperform the other. So, you're not just bullish on one specific asset, you're kind of bullish on one and bearish on the other, and you're trading differential between the two. Because you may well be bullish on one, but if the other side of the pair is bullish as well, then it's just going to sit there and do nothing, right? So it's a little bit different, the long versus short. You've got to kind of work out a little bit more in terms of, well, if I think dollars going to go up, what do I want to pair it against? I want to pair it against the weakest pair. So what's the weakest pair? So perhaps there's a little bit more distinct kind of analysis to do in that. That's just my opinion on that. Some people might be like, no, I just do TA on the charts and it works for me, and that's cool. But I think long versus short, if there's a bad stock out there, it's looking awful, then there's an opportunity to go short. And that, I think, is why you get these more extreme swings, because if it's bearish, it's bearish. It's not a case of, oh, well, it's bearish, but the other country's bullish, a little bit bearish, a little bit this, that, the other. Often you kind of get these supply and demand small shifts, but big ones are much rarer. So anyway, guys, that's FX versus stocks. Let me know your opinion in the comment section below, which one you prefer to trade and why. Take care. Bye-bye.